We're delighted to have Matt Maley on the show today. Matt is the Chief Equity Strategist for Miller Tabak, a capital markets and investment firm known for its excellent trading and equity research. He is also founder and CEO of the Maley Report and author of the Benzinga Stock Picks newsletter. Previously, Matt was a senior sales trader for Merrill Lynch and Salomon Brothers. He holds a Bachelor of Arts in Political Science from Colby College. Matt, welcome to the show.
Great. Thanks for having me.
So for our investors who are sort of meeting you for the first time, can you just tell us a little bit about Miller Tabak? I mean, I guess you're really known for your research. Give us a little quick introduction to the firm, if you could.
Sure. Yeah. Well, our is kind of a small boutique type of firm. Boutique might be too strong of a word, but we do cater to all the biggest institutions, not just here in the U.S. but around the world. And we it's interesting because we really concentrate on certain areas of the market, try to look at the things in a more macro way and see how they all come together. Not just in the equity markets, and not just in the U.S. equity markets, but what's going on in the currency markets, commodities markets, whatever it might be, and of course the global markets, and see how they come together to and we really try to find the key turning points, not just in the overall markets, but individual sectors and individual groups. And one of our biggest, especially, is in the options area. That's where a lot of our flow is from the institutional investors.
I want to actually get right to the elephant in the room, and it's sort of dominating the market thinking right now. You mentioned it in your Substack today, and you mentioned it in your last weekly top 10. There are two elephants in the room. First, the profitability of the AI sector, and then maybe even more importantly, how AI could disrupt everything else. And you mentioned the Citrini research. I guess let's talk about the thing that I think has a lot of people worried is how AI can disrupt everything else. With all the some of the doom that's going on around that, we're looking at a substantial shrinkage of the white collar workforce and the cascade that leads in a service dominated economy. What are you thinking?
Well, I must admit, it's something that is a big concern. Now, this report done by Citrini is very, very interesting, but it's very much hypothetical as well. I mean, they don't go into a lot of details about how many people are going to lose their jobs and how quickly it will happen, and how much of it will cause how much earnings might be impacted. So it's a little bit vague in that respect, but it is something that I do concern myself with. I mean, the whole thing is that with this recent movement in certain sectors of the stock market, I mean, it started with the software stocks, which really started getting clobbered even late last year. More recently, we've seen it in other areas, especially in the financials and such, and that's got people scared about what's going to happen, what's the impact going to be. However, it's what's getting lost a little bit is the profitability of a lot of these companies that have been making money in the AI industry in the last couple of years. And that was something people were thinking about a month or two ago, and that seems to fade away in the narrative on Wall Street, but it's still very, very important because a lot of companies have already had to be revalued. And it means that a lot more are going to have to be revalued. And if those are revalued, they're obviously going to have to be revalued down. Now, going out further, it's funny because the Citrini report is as negative as it sounded. They did talk about that, heck, the market's going to go to 8,000 before it tops out. So that's still another 15% from here. So it's not as bad as maybe some of the headlines showed. But there's definitely a situation where you have a turn down in the economy that people are worried about because in so many other instances in the past where jobs have been ended because of the new technology, but it also opened up jobs at the other end or in other areas. And in fact, in some cases, for every job that was displaced, two new jobs were created. In this case, the big concern is that it's just going to replace jobs completely. And what does that do to the consumer, especially here in the U.S., because it's a consumer-based economy?
I guess what they kind of eloquently said was so much of the services economy, 70% of our economy, is sort of intermediation, and perhaps this time they're actually disintermediating the human, and the human intelligence that was so prized that AI could do much better. Just as an example, my daughter was signing her first apartment lease in California. I said, Dad, read it. Tell me what you think. And I said, why am I reading this? Let me just upload it to AI and have them tell me if it was boilerplate or not. And now I don't know. I'm not an attorney and I don't know anything about California, but gave me the answer in 30 seconds. So I think that's a little scary. I think that's what's getting to people.
Yeah, there's no question. I mean, one of the things on a near-term basis, I mean, I look at stuff all the time. I'll just go back and I'm writing something about what's going on in the market, and I'll look back into a previous similar example, and I'll ask AI, well, what were the details? I can't remember how much did the market go down at that time, or what if, and it'll come back, and I'll go, that's just wrong. It's factually, but luckily I realize that it's wrong because that's what I do. But if I was asking for a legal issue and I didn't know it was wrong, that could create problems. However, as a lot of the people are starting to think now, is that as we move through time, those facts will be a lot better, and there won't be giving bad information. So on the one hand, we're still going to need people because you still want to have somebody to, as we always used to say in the trading side. I spent a lot of time as a trader, and we'd say we always want somebody to blame. Somebody screwed up. It was the trader's fault. It was the customer's fault. Whatever it happened to be. And who are you going to blame if the legal issue isn't the right one? Or who are you going to if you have a bad diagnosis from a doctor, you want to be able to go back and say. How can you fix this for me? And so, I don't know if it'll be as bad as some of the worst fears, but it's definitely going to be something that's going to have a big impact and something that is a lot different than we've seen in the past.
I think you're right. And right at the bottom of the disclaimer of the AI, it says the AI can be wrong. Be careful. That's their generic disclaimer. I guess one thing I figure is I think it'll take longer than their sort of what Citrini was saying, but it's definitely potentially a secular change that we've seen in the financial markets. Secular changes can be pretty big. But you touched on something I wanted to ask you about with the profitability of the AI sector itself. That's been sort of a little bit in the back of the mind. For all the the hundreds of billions that are getting spent by the hyperscalers that these AI companies, OpenAI and Anthropic, have promised to pay for, what is the total addressable market? Have we forgotten about that in terms of how many people are paying even paying $20 for the Chat GPT Plus or some equivalent? Is that profitability going to come back and be really important?
Well, I mean, the problem is at $20. I guess my biggest concern about this profitability issue is that some of these hyperscalers, like an Amazon, they don't care if they're profitable or not. Google the same way. They make so much money at other businesses that they can afford to run this at a loss or even run it at maybe flat. That's fine, but they are not going out of their way to make money on this. They're going out of their way, much like Amazon did. I mean, remember what happened with Amazon? Amazon stock went down 90% during when the dot-com bubble burst. Now, it was funny. As it was going down 90%, their earnings and their revenues went up every single quarter over those 2 or 3 years. Every single quarter. But the problem is it had gotten so highly valued that it had to come down even though they were starting to make money. But either way, it didn't matter. They were more interested in market share. And therefore, they were one of the big winners. And so even though the stock went down 90%, it rallied 35,000% over the next 10 years. Some of these big hyperscalers, I don't know if it's the same thing. First of all, they're not going to go down 90% because they're not as expensive as NVIDIA was in the late 1990s. But the issue is that what is OpenAI going to do? Because they don't have a lot of other products. They don't have any other products, basically, that can make them this money where they can afford to run at a loss for an extended period of time. So I guess my point is when you have these people, these companies fighting it out and people not having to pay much for it, how are they ever going to be profitable in a significant way until things get down to a size where just a few players are in the business?
Or, as I sometimes think, maybe the hyperscalers will end up owning the AI because you promised to buy $600 billion from one of the hyperscalers and you can't pay for it, is there a clause in there that goes, well, I guess we will just have to take the company and it becomes Amazon AI or Google AI or something like that?
Right. And that again, that's fine and over the longer term. But right now we have a stock market that's still very expensive. And even the people talk about how the S&P 500 equal weight index is not as expensive. Well, no, but it's never as expensive as the S&P. And it's also starting to get more expensive than it has been in a long time. So you have an expensive stock market. You have credit spreads that are super tight, which most people try to think is that as bullish. I actually, that's actually not a good sign. At least eventually, that those have to widen out. So when you have a some froth in both the stock market and the bond market, what's going to happen when we see a broadening out of the revaluation? I mean, everybody's been talking about the broadening out of the AI business and how it's going to the earnings are all going to broaden out. What I'm worried about is that we're going to see a broadening out of the reweighting, or the revaluing of some of these stocks. And do remember when the dot-com bubble burst, that's what happened. It was just a reweighting of an entire industry. The stock market got hit hard, but the economy didn't get hit. I mean, we had a very mild recession. So, people are talking about, well, I'm not seeing anything that's going to be, a big problem for the entire system. That's fine, but that doesn't mean the stock market can't go down. And just look what happened in 2022. We had a 25% correction of the stock market, and yet we didn't have a recession.
Two very good points. I do. We mentioned you mentioned something a little bit earlier, and I want to get to it because it's again in the top of mind. The software IGV been absolutely hammered, and perhaps in large part due to Anthropic and the advances that they appear to have brought to the market. Is this the time to buy the dip in SaaS and IGV, or thinking that you're not going to actually use Google Sheets to replace Excel, or is it if you get 10% fewer subscribers to the SaaS, then those guys would be in trouble in terms of recurring revenue? Is this a buy the dip moment in IGV? What are you thinking here?
Well, I must admit, I'm worried that on buying the dip might, as a former trader, buying the dip could work very well here on a near-term basis. But I do worry that that the real issues that are coming from this haven't been fully played out. And it's funny too because we're kind of moving into at least in the U.S., the seasonally tough time for the market. Everybody talks about September and October being the weak time for the market, which is true. But we also tend to see that from mid-February to early April as well. And so you might see a little bit more selling off. And again, as an ex-trader, one of the things I'm looking at right now on the technical side of things is you look at the IGV, which is the ETF for the software stocks, that it dropped below its 200-week moving average. And I think yesterday, when it dropped below that level, boy, some of those dippers, the people who've been buying on the dip said, I'm out. Some of that fast money dodged out of it. Now it's trying to bounce back. If it can regain that line, that should be something that could help over the next couple of weeks. And if it fails that line and creates a new low, that's going to be a big problem. So we're kind of at a key level, at a key juncture here over the next week or so in the software stocks. But I think on an intermediate to longer term basis, I think the line of least resistance is still a little bit lower.
Right. Would be a good time to say, you know what, I want to get out of the delta and maybe buy, just spend a little premium, buy some options, and better to lose the premium than than perhaps to ride something lower. Perhaps that additional correction as you mentioned.
Yeah, I mean that's definitely the way to play it. I mean, you use a little bit of that a creativity in times like these because it's always hard to catch the falling knife. And I guess the other thing though is don't worry about catching that falling knife. My biggest thing is if you buy something, you nibble a little bit here, no matter what strategy you use, and then the stock starts to move up. Don't be afraid to add. There's so many people who say, they bought a little bit very near the bottom, and then they see a big bounce, and they go, oh my gosh, I missed it, and they just walk away. I mean, that's the biggest mistake. That's when don't be afraid to get aggressive as the thing moves up. I mean, let's face it, if you buy something at 30 and add to it at 35, and your average price is 32 and a half, Well, you've bought something that's in the money. Then you use that average price, again, depending on the kind of strategy you're using, as your stop out level. And then if you're lucky enough that you did catch the bottom nicely, you can just let it run.
No, you're so right. As a former trader myself, and I still do a little bit of it from time to time. Some one of the best pieces of advice I ever got is sometimes you have to buy the upper right hand corner of the chart.
Absolutely. I mean, it's especially. I mean, the other thing. I mean, think of the other side. You're buying on the way down, and you buy something, and it goes down. Well, and then you average in. It's like, well, great. I've got something that I bought at 30. I bought at 20. Its average is 25, but it's trading at 20. Now I'm relying on hope.
Yeah.
So, and that's not so. That's why when you see that kind of, especially when you come out of a situation where something's getting beaten up, oversold, when it bounces back in a meaningful way, don't be afraid. Like you said, don't be afraid, especially when it breaks the key resistance levels. By that breakout, it can run.
Just a quick word on Kevin Warsh, the new Fed chair. It's interesting that he was historically always a hawk, and even though he might try to push for a few, maybe a couple more rate cuts than that's already priced in. We've only got 2 priced in, I think, so for the rest of the year. There seems to be a lot of resistance, particularly among the regional Fed presidents, and even oddly, Austin Goolsbee, a former, sort of, I guess, Obama hand. You would have thought he'd be a dove, but he's actually been tacking hawkish. Can Warsh, do you think, even wheedle an extra cut or two out of out of the committee, perhaps by saying, "Give me a cut now, and we'll just get the president off our backs"?
Yeah, we'll have to see how it plays out because the one thing is that it seems quite evident that he wasn't going to get the job if he didn't get some sort of guarantee or didn't give the president some sort of guarantee. And I don't know to what degree he gave it, but we also have to understand that it's one thing that a lot of people don't realize in the investment community is that the Federal Reserve is not a government agency. And it is owned by the banks. Yes, they are nominated by the president, passed by the Senate, the governors, and of course the chair. But if you call them up and say you want some information under the Freedom of Information Act, they'll be more than happy to tell you we are not a government agency. We do not fall under the Freedom of Information Act. I think that we might see a bit of a surprise where he tries to where Mr. Warsh comes out and declares his independence relatively early. My one concern about that thought is, of course, is that again he must have given President Trump some sort of understanding that he'd be helpful at least before the election, before the midterm election. But we'll see how the whole thing plays out. But that's the one thing that I think a lot of people, they do think that, well, Warsh is just one person. This is not the Supreme Court where every person is completely independent of one another. They think as a team. When they give public comments, everybody knows what they're going to say in beforehand. So there's going to be some volatility involved once assuming he is passed by the Senate, that once he takes office.
Right, and Senator Tillis is going to remove his block if they can get rid of this silly thing about going after Chair Powell. As a gold trader, formerly sell side and now for myself, remarkable move. 5,000. I mean, yesterday was some great price action, broke clearly back above the the highs of the bounce. So new highs of the bounce. What do you have a target? I mean, it is really just it has moved so much and so quickly, given all the concerns about debt, about the premium around debt, uncertainty in many different places. I mean, a medium to even a longer term target on gold.
Yeah, my target has been 6,000 on gold since the beginning of the year. I think there's a very good chance we'll reach that. In fact, I think I'm starting to think I'm a little bit low. The thing is that, again, we talked about the situation with what's going on with these budget deficits, so that we actually have concerns surrounding sovereign debt. But now, we saw what the CEO of J.P. Morgan, Jamie Dimon, talked about recently. With it's not just the debt of AI, but it's throughout the entire system. We can argue about whether we're really in a bomb bubble or not. but or how big the bond bubble is. But I think we're in one, whether it's as big as some people think or not. And the one place where people can feel comfortable about getting protection is in the gold market. It's worked for 5,000 years. I think it's something that could work in the future. And the best thing about it right now, of course, is that it's been something that has outperformed the stock market. Usually you buy that protection, and then when the stock market keeps rallying, gold goes down. Well, that hasn't been the case this time around. And again, on the technical side of things, it does nothing but make higher lows and higher highs. It saw the big sell-off after that kind of parabolic move in January. But I think that it's provided building a nice base now. And if we break above 5,500, if we break above those recent highs, I think that 6,000 level could be reached by this summer.
It certainly seems that way. It's broken, sort of what a lot of people thought. Gold was very quiet for the teens, and it certainly isn't that now. In terms of, let's say that the Chinese who moved their holdings of gold reserves from 3% to around 6%, give or take, maybe a little more now with the appreciation of the asset. Let's say they get it to 10%, in 2 or 3 years. Where do you think gold gets to before it really stabilizes? And I know it's a tough question because I'm asking you to basically sell an option at a certain level, but where do you see it in 3-5 years time?
Well, you always like to use these big round numbers like 10,000 and such, but I think 8,000, 8,500 is very doable. And 10,000 is not out of the question either. I mean, the one thing I always joke about, when we're asked questions like these, if you put the number too high, all you can be is wrong. So if you put one here, and then you put one, then when you reach it, you raise it again, and you can be
You were
right three
for a
times
moment.
instead of just once, right? And so that's a little trick of the trade, as they say. And so I don't want to be like that, but I just look at what's going on. 15 years or more than that, 16 years since the great financial crisis. And we haven't really had the normal cycles. Every time, that we've had any kind of a problem, the Fed has come in, or in some cases, global central banks as a whole have come in and kept the normal cycles from taking place. Sometimes that was absolutely the right thing to do. It was like during the pandemic. But other times where it's like, maybe if they, cause a little bit more, let a little more pain take place, people wouldn't have brought in so much froth in the marketplace. I mean, just looking at a thing right now is that margin debt in the U.S. has been making records every month for a while. But now, if you look at margin debt versus the market cap in the market, when you look at margin debt versus market cap, which is something that people have been saying, oh, don't worry, it's not a problem. Well, now it is. It's now at an all-time high. So you have so much leverage in the system. And when leverage has to be unwound, that's when you get forced selling. And what do you do when you see forced selling in the marketplace? You go to the places where you can be protected. And that's why I think that gold is going to continue to work very well.
I think it's a great point, and I think gold's brethren, silver, saw some of that margin force selling in that collapse at the end of January. I want to shift gears a little bit in terms of the sort of U.S. markets versus other markets, international markets, emerging markets. Certainly, some of the Asian markets, Korea has outperformed the U.S. last year. I think they may be outperforming again. Is there any concern that people are saying, you know what? The U.S. has led for a long time, but with the potential for a weaker dollar, although that's sort of stabilized, potential for a weaker dollar and growth elsewhere. Do you see signs that foreign investors are saying, you know what, the U.S. has done really well for a while, but now it's time to shift allocations a little bit? And if you get, at the margin, a reasonable shift in allocations, that will probably drive some a difference in valuation. So are you seeing that? Are U.S. So is there going to be an allocation, or people thinking about moving some stuff out of the U.S. market entirely?
Well, I say it's interesting because from foreign investors, yes. But we're also seeing from domestic investors. I mean, they're not going to say, hey, we're going to move completely out of the U.S. by any stretch of the imagination, but a lot of them are starting to allocate to other areas. The one thing I'm a little concerned about again, only on a short-term basis of being a former trader, is the South Korean market. The Kospi is very overbought. It's had this great run. The outlook is still very good, but at some point, it's getting overbought by several different measures that I look at. So maybe be a little bit careful about chasing it over the near term, over the next week or two. I'd be a little bit more comfortable if it would pull back a little bit. But other areas, emerging markets, like emerging markets, I do think even though the dollar is stabilized, I think it's the line of least resistance is lower. That's good for emerging markets, good for hard assets as well, and which helps most emerging markets. And so that's very helpful. The other thing that I find very, very interesting is that Europe, a lot of people are very, very bullish on Europe. That market's not particularly expensive, and I can see why they like it. But we have, they've got issues there. Their economy is fine, but it's not doing great. And again, they have these issues, whether it be, especially in the UK and in France, where their budget issues are a lot worse than I think most people realize. And if those interest rates start to move up the way they have in Japan, that could create some problems. So I'm looking at other areas in the world besides Europe, which makes me, I think, a little bit different than from what a lot of people are looking for here in the U.S.
Certainly the European economies are less flexible than ours, certainly in terms of employment and other things, and they may be getting a boost from defense spending, which may or may not last. Well, would see what emerging markets, are there any certain markets that you're like these two are sort of my favorites? I think various for any number of reasons I'd like to maybe park some funds in those countries to the extent they're investable.
To be honest with you, I Vietnam has been one that I've liked for a long time, and that's kind of where I've allocated or pushed people towards. But for most of it, a lot of the people that we talk to are more interested in the general emerging markets area overall, and then they look to others other than myself, to be honest with you, to look at which specific areas to go through, because that's their areas of expertise and not really mine.
Last question, and this is for the benefit of some of our really dedicated investors. In the next few months, what major things should you be looking out for? Is it is it the potential for a Fed, a difference? The Fed's looking at things differently, as we've mentioned. Is it something with the tariffs? What things should they be looking for that if we see this, then we really should be careful or pay attention?
Well, I mean, there are obviously a number of different things. Of course, if we see a situation, the tariff thing, I think they've got plans to take care of that. The other thing, though, is what's happening in the fixed income market. If we start to see more cracks like we have with Blue Owl, where they froze up one of their private credit funds, that's where I would be a real canary in the coal mine. However, the one thing to watch the most closely is the chip stocks, the semiconductor stocks, the SMH semiconductor ETF. That has been the most important leadership group in the U.S. stock market for decades. So it's not just been since AI became a big deal. It's been that way for decades. And it's never a lagging indicator. Sometimes it's a coincident indicator. So sometimes it trades with the market. Whenever it diverges from the S&P is always the one that's wrong. So if the S&P, which has been, I guess my point is, we've seen a lot of volatility in the tech area. It's not just been the software stocks that have gotten hit. A number of the Mag 7 names have been hit pretty hard. But those chips have been holding up very nicely. Therefore, the stock market's held up very nicely. If you start to see the SMH semiconductor ETF start to break down, that's going to be a big red warning flag. And the reason why I'm choosing that over credit spreads is that people are always talking about credit spreads and how important they are. They are. The problem is they're not a leading indicator the way the SMH is. I mean, the SMH isn't always a leading indicator. Sometimes it's a coincident indicator. But if it confirms a downward reversal, pay attention. The problem with credit spreads is they really don't widen out in a meaningful way until the market or the problem has already become a pretty big one and the stock market has already fallen 10% or more. So keep a close eye on those chip stocks. If they start to fail, then we got some problems.
Well, that is excellent advice. Matt, thank you so much again for your time. Look forward to having you back on the show again.
Thanks very much.